This is part 5 of our Chapter 3 video lecture, where we're going to be calculating the taxable amount of pension distributions. But before we do that, here on page 8 is a topic called Penalties that's related to retirement income. The government gives you some tax breaks to save for retirement. So that means they don't want you to take out the money too early. If you do take it out too early, there will be a 10% penalty that's in addition to the income taxes you have to pay. So when is it when you take out the money too early? Here it says that if you take out the money before reaching age 59 and a half, any taxable retirement income you have is not only going to be subject to income taxes, but it's also going to be subject to this 10% penalty. Now, there are some exceptions to avoid this penalty listed in this list here, 1 through 7. There's an additional exception. Because of the COVID-19 situation, the government allows you to avoid the penalty up to $100,000 of taxable retirement distributions. Again, you still have to pay possibly the income taxes on that retirement income, but you're going to be avoiding this 10% penalty. The way to calculate the penalty is on this form 5329, where you would enter the amount of the early distribution, again, before reaching age 59 and a half, minusing out any one of those exceptions listed back on that our textbook 1 through 7. And here we multiply it by 10% and then put that extra tax on Schedule 2 and then transfer it to the 1040 form to combine it with the regular income tax. Let's take a look at the main topic for this video, which is the taxable part of any pension distribution. So pensions are typically retirement plans that are set up by the employer, versus we saw back in the previous video, individual retirement accounts are set up by the taxpayer or the employee. And most times, all the pension, all the profit sharing of the employer is going to be taxable to the employee. But if the employee had probably voluntarily contributed into the employer plan and wasn't able to reduce their taxable wages in those years they were working, that means there's going to be non-taxable distributions to the employee. So we're going to try to figure that out, yeah? So let's first take a look at this example before we calculate out anything here. So we have Jason, who's age 65, so we know that he's going to avoid that early distribution penalty. And he's going to receive $4,000 a month beginning on, looks like the date he retired, July 1st. So that means he's going to receive 6 months worth of $4,000 each for the current year. So, and this is going to last for the rest of his life. So we're told he's expected to live another 260 months. And we'll see how this is calculated as we work through this problem. We're also told that he had put into the retirement plan $124,800 that he didn't deduct, so he got no benefit as he put this money in. Here they say it's so-called after tax. He already paid taxes on that contribution, so he should be able to get back $124,800 tax-free over his lifetime. So the question is, now how much of the $4,000 he gets every month is taxable, and how much of it is tax-free coming out of this $124,800? We're told to use a formula, this formula here, which is different than the one we had seen for the individual retirement account. Here at the top of the fraction, is the after-tax contribution. In our case, that's the 124,800 amount. And then in the denominator of the fraction, the number of months that he's going to live. So the way we figure that out is to use this table. We call this a simplified method, even though it may not be looks too simple. So on the date he starts collecting the money, we are asked, what is his age? And we're told he was 65. So we go across, and here is his life expectancy in terms of months. Of course, this is just an estimate. He could live less than 260 months or more than 260. But just to keep it simple, we're just using this table. So we put that in the denominator. So when you divide it out, your answer comes out to $480. That's going to be non-taxable for each month that he collects his pension. Remember now, his pension is $4,000 a month. So for the first month, he's going to collect 6 months worth, or $24,000. And then this $480 that's tax-free, that's also for 6 months for the current year. Of course, next year is probably going to be 12 months worth, a whole year's worth. But for this first year, tax-free would be $2,800. So the difference between the two is what's taxable, $21,120. Of course, we're doing all of this on scratch paper, yeah, but this is the way it should be reported. So back, remember now on the 1099 form, coming from his employer or whatever financial institution is handling the pension plan, they'll issue out 1099-R forms to our retired employees, in this case Jason. And here is the amount that was distributed to him for this first year that he's retired. Most times you'll see the taxable amount calculated for us. So we don't need to go through this formula we're doing now. But if it's not given, unknown, this box will be checked off. You also need to look over here in box 9B that shows you how much was contributed by the employee over their work life that they may recover tax-free. So we were given this amount in the problem. Another thing to watch out for is this box number 7 with, in our case here, code 7 indicate this is a regular or normal distribution. If you remember back in that previous topic we were talking about penalties, that 10% penalty, where the taxpayer employee is under age 59 when they started to collect the distribution, most times you'll see a code number 1, meaning that it's an early distribution before reaching that 59 and a half age. And again, not only would the amount over here be taxable, but there would be a 10% penalty on that taxable amount also. In any case, again, what we calculated out is all of this. So this 24,000 is going to be reported as the total amount received, and 21,120 is what's taxable. So now if we go to the 1040 form, where eventually all the income is added up, we'll see in the line for pension, let me write it in here. The pension line, that's for line 4C. What we'll see is the gross amount of 24,000, and then in the next column, looks like 4D, even though there's B's up here, but 4D, that 21,120 that we had calculated, and we would add up that with all of the other income of the taxpayer and take a total. Now, most people don't have a textbook like we have, yeah, to calculate out the amount. So in the instructions to the 1040 form, let's see if I can find it. I have it linked in our Laulima resources folder. Looks like it's on page 26 of the 1040 instructions. would be this Simplified Method worksheet where it goes through the calculation we had just done. Here's that mortality tables again. Yeah, remember our taxpayer Jason is 65 at the time he starts collecting the retirement benefits. So he's going to be um, living another 260 months. Now, if the retirement benefits is going to be paid over the life of the taxpayer and the spouse, what we would do is add up both of their ages at the time the annuities, the pension starts. And whatever that total is, we go across and use this as the denominator in that fraction. Let's go back to that calculation again. So let's say that the taxpayer lives longer than 260 months. Well, by that time, you use up all of this 124,800. So at that point, all of the $4,000 per month is taxable. You've used up all of that tax-free uh, distribution. How about if the taxpayer lives less than the life expectancy in this calculation? That means there's gonna be unused contribution out of that total we had seen, this amount here. In that case, possibly on the last tax return filed for this taxpayer, we can claim an itemized deduction for the unused contributions. Yeah, weren't received tax free. Now we can possibly take a deduction, but you gotta claim itemized deductions versus the standard deduction we had learned back, I believe, in chapter 1. Let's briefly talk about the next topic, which is annuities. Annuities probably may not be related to the taxpayer's employment like we had seen for individual retirement accounts and in the previous section for pensions. Probably the taxpayer or this annuitant, an investor, will go to an insurance company and want to buy an annuity for so many years or for the rest of their life. They want to collect money. So the amount they invest, that's this amount here in this new formula, the amount paid, is eventually going to be paid back to the taxpayer tax free. Here in the denominator of the fraction is the total dollar amount the taxpayer expects to receive over the lifetime, not tax free, but the total amount. So again, we need to know the life expectancy of the taxpayer, which is built into some other mortality tables that are not given here directly in our textbook. Okay, so most times the insurance company may try to figure this out for you on the 1099-R form. Anyway, using this fraction, we would multiply the amount received for the year to get the amount that's non-taxable for the year. And the difference between these two amounts would be the taxable amount. So again, in the 1040 form, we would include the annuities in this line 4C, the gross amount received during the year, and then just the taxable amount here combined into line 4D. Yeah, again, this 4C is used for both pensions and annuities. IRAs are used in line 4A only. Again, looking back on the 1099 form, if this box is not checked off here, that usually means you're dealing with a pension or employer retirement plan. If it is checked off, that means you're dealing probably with an IRA. Okay. Let's see. One more topic here. So again, the government we saw is trying to make you save for retirement by penalizing you if you take out your money too early. But the government wants you to pay taxes. So they're eventually going to force you. Let's see. They're going to force you to take out money from the retirement account. Page 9. Okay, so in this paragraph here, the textbook talks about the government forcing taxpayers to take out money from their retirement account so they are going to be paying taxes, yeah? You cannot just indefinitely leave the money in the retirement account. Under the old rule, you have to start taking money out when you're age 70 and a half. But under the current, what they call CARES Act, this is a law that was passed to help with the COVID-19 situation. The retirement, the age is now moved to 72 before you're required to start taking out distributions. So just about a year and a half more. Okay, so go ahead and continue into the next video where we'll talk about taxing possibly Social Security benefits.